In today's video, I'm going to teach you everything you need to know about the RRSP. I'm going to cover the following questions. What is it? What's the difference between an RRSP and an RSP? I'd like to show you how you can use this account to minimize or lower your taxes. And at the end of the video, I'm going to show you a few things you can do with this type of account that you may not have known that you could do. So let's get into it. Let's start off with some of the very basics. RRSP stands for Registered Retirement Savings Plan. Now you may be asking yourself, what does registered mean? Now there are two types of investment accounts. There is registered accounts and there are non-registered accounts. In the registered accounts, the government tells you how much you're allowed to put in every year. In the non-registered accounts, you can put in whatever you want as long as it's all legal. If you want to know how much you can contribute to your RRSP, you will need to know how much money you made last year, gross, and then you will times that by 18%. Now, the government also sets a limit on how much you can contribute, and it's not just that 18%. For 2021, the maximum RRSP contribution was $27,830. So which number do you use? You use whichever number is lower. Of course, you could always just log into My CRA online and look at how much RSP room you have. And starting in 2022, your maximum RRSP contribution will be $29,210. So now we know how much we can put into our registered retirement savings plan. What do we do with it? What is it? An RRSP is an investment account. It does have savings account in the name, but don't let that fool you. It is not a savings account. Not in the traditional sense like you would find in your bank. It is also a tax-sheltered account or a tax-deferred account. You will often hear the term tax-deferred or tax-sheltered account when talked about with the RRSP. This just means that any investment growth that you have in this account, you are deferring the taxes to later. And I'll talk about the taxes related to this account in just a minute here. So what's the difference between an RRSP and an RSP? Basically, it's just a shortening of the acronym. Most people will drop the registered, the beginning R, and just go with retirement savings plan. And anyone can open an RSP at any age as long as you've had earned income in the previous year. Before I lose you, because I'm about to start talking about taxes, if you are enjoying the video and getting some value out of it today, then please let me know by hitting the thumbs up button. And if you'd like to see more videos around personal finance, understanding how your money works, please hit subscribe with the bell notification so you can stay up to date with my videos. Taxes. Nobody loves them except for the government. I'm going to talk about this very simply, very high level. If you earn income from a legitimate source in Canada, you will pay tax on it. Now, if you'd like to reduce the amount of tax that you pay, you can use a registered retirement savings plan. Here's a hypothetical. Let's say you've earned $50,000. You don't have an RSP, so you're not making any contributions. You will pay tax on that $50,000. Now, let's just say for the sake of math that your federal tax rate is 20%. In this example, you would owe the government $10,000 of taxes. Now, let's use the same amount of income, $50,000, but you're going to make a $5,000 contribution to your RSP. This means you get to reduce your taxable income by $5,000. So your taxable income will be $45,000 at 20%. Now in this example, you have earned the same amount of money, $50,000, but you've made a $5,000 contribution to your RSP, and it will reduce the taxes that you pay on your income. So this means that your taxable income comes down to $45,000, and 20% of $45,000 is $9,000. So by investing $5,000 to your future, you have saved $1,000 in taxes. Now, the retirement savings plan is supposed to be a long-term account. It is not something that you are supposed to put money in and then pull out right away. If you are in a situation where this happens, any money you pull out of the RSP is considered taxable income. So if you pull $5,000 out of that RSP, you will then be taxed as if you've made an extra $5,000 that year. And when you pull money out of your RSP, you do not get that contribution room back, unlike the tax-free savings account, which I will talk about in a different video. Now let's say this year you're not quite sure how much money you're going to make. The federal government allows you to do something about this. Within the first 60 days of the following year, you are allowed to make contributions to your RSP and have it count to the previous year. You can only do this within the first 60 days. If you go into a bank, they will commonly refer to this as RSP season. If you make a contribution within the first 60 days, it doesn't have to be applied to the previous year, but it's something you can do. And the way you tell the government what year it's being applied to is when you file your taxes. So you've made a contribution to the RSP. What do you do with it now that it's there? Because the RSP is an investment account, you can choose to put your money into any number of investments. You can hold it in cash if you so choose. You could decide to put it in the stock market, so you could buy individual stocks. You can also buy mutual funds or ETFs, exchange traded funds. You can buy GICs, you can buy bonds. You can even invest in REITs, real estate investment trusts. All of these types of investments come with different degrees of risk. And knowing what to invest in can also be a challenge, and it's a video topic that I will cover in the future. There are also 2 programs you can use to make withdrawals tax-free from your RSP account. One is called the Home Buyers Plan. This allows you to withdraw up to $35,000 for the down payment of a house. Now, if you are buying this house with a spouse or with a partner, you can both withdraw up to $35,000 from each of your own RSP accounts. You do have to pay this money back to the RSP, but you have 15 years to make the payments back. If you don't make the payments back to your RSP, you do have to claim what you should have paid back to the RSP as earned income on your taxes that year. And that's not all at once, that is spread out. So that means if you withdrew the current maximum of $35,000, you would have to pay back $2,333.33 every year for 15 years. You can pay more back at any point, but again, if you don't pay back anything or less than what you should have, you have to declare the difference as earned income and you will pay tax on it then. There are also several other conditions with the Home Buyers Plan. It has to be your main home. You can't use it to buy an investment property. You also can't have owned a home for at least 4 years before you make the withdrawal. Now, the second program you can use to withdraw money tax-free from your RSP is called the Lifelong Learning Plan. This is for you, your spouse, or common law partner to upgrade education or get an education. You can withdraw a maximum of $20,000 from your RSP, but you can't withdraw more than $10,000 in a calendar year. Same rules apply to this program, where you have to pay the money back after you've borrowed it, but the time frame you get to pay this back is only 10 years as opposed to 15 from the Home Buyers Plan. And lastly, at the age of 71, you do have to convert your RSP account into what is called a RIF account, or a retirement income fund. If you'd like to learn a little bit more about the tax-free savings account, then please click this video up here. Or if you're more interested in the RIF account, then check this one out over here. My name's Nathaniel, your host for Uncommon Sense.